Tonight at 3 a.m. Eastern, something is about to happen in the London silver market that we haven't seen in over 40 years. And if you're holding silver or thinking about it, the next few hours could change everything. Here's what you need to guess. What happens when Shanghai is willing to pay $14 per ounce for silver while London prices it at $86? One of them is lying. And at exactly 3 a.m. Eastern Time, when the LBMA opens its pre-market session, we find out who blinks first. Stay with me for the next 15 minutes because the numbers I'm about to show you reveal a structural crisis that's been building for weeks, and tonight might be the moment it breaks wide open. Let me give you the setup. Right now, the Shanghai premium over London is sitting at 18.47 per ounce. That's a 21.3% gap between what the East is willing to pay and what the West is pricing. The last time we saw a sustained premium over 20%, silver rocketed 8.47% over the next 14 months. But here's the part that makes tonight completely different. The London vaults just reported a 12.7 million ounce withdrawal in a single week. That's not paper contracts being shuffled around. That is $1 to $1.08 billion in physical metal walking straight out the door. To put that into perspective, 12.7 million ounces equals about 395 metric tons. Picture two fully loaded Boeing 747 seconds made entirely of silver gone from London in just 7 days. Now the LBMA might move 200 million ounces a day in paper trades. But when physical metal leaves the vault, it's a completely different story. You can create infinite paper contracts with a keystroke. You cannot create physical silver. And tonight, London has to price that reality. This is the moment that could finally separate the paper market from the physical one. London doesn't just set a price, it sets the price. It's the benchmark for over 50 billion in daily transactions. But what happens when that benchmark no longer reflects reality? What happens when one market says silver is worth $104 and another says it's worth 86? The arbitrage pressure becomes undeniable. The East is calling the West's bluff. And in a few hours, we see who cracks. Let me show you the hard numbers. As of right now, London spot silver is at 86.40. Shanghai spot silver is at 14.80. That's the 21.3% premium I mentioned. On top of that, COMEX registered silver, the inventory actually available for delivery, is down to just 31.2 million ounces. That's a 17.4% drop in 6 weeks. The LBMA's own vaults are bleeding, down 12.7 million ounces just last week. Even the big silver ETF, SLV, has 47 million ounces tagged for delivery requests that haven't settled yet. And here's where it gets wild. There are still 400 open contracts for March delivery on the COMEX, even after the deadline to close them has passed. That represents potential demand for 142 million ounces of silver against an inventory of only 31.22 million ounces. Pause. The math simply does not work tonight. London has to price what happens when the math breaks down. But here's the part nobody's talking about. It's not just about inventory, it's about who's setting the price. 3 of the 5 major banks involved in the London fix, HSBC, JP Morgan, and UBS, are reportedly under internal stress. They are collectively short 284 million ounces of silver through various derivatives. Think about that for a second. You're short nearly 300 million ounces, but there are only 31 million ounces available for delivery, and the vaults are being emptied. You have 3 choices. 1, you cover your short positions by buying, which sends the price soaring. 2, you roll your positions forward and pay a premium, signaling scarcity to the market. 3, you try to deliver physical metal you don't have, which means default. None of these options are good for those betting against silver. And tonight, they have to choose. A major bullion dealer who supplies 3 European banks recently said, quote, "We haven't been able to source 1,000-ounce bars at spot for 11 days. Everything is spot plus $6 to $8 minimum." That isn't just a premium, that's a rationing signal. Tonight, London must either acknowledge this reality or risk losing its credibility entirely. If you've tried to buy physical silver lately, you already know the deal. Dealers are reporting inventory stress. Some have stopped selling silver eagles altogether. Others are quoting premiums of 30 to 40% over spot for regular retail products. But the real story is in the wholesale market. The big 1,000-ounce bars that trade in London now have premiums of $4 to $6 over spot. That's a massive shift. When wholesale premiums spike, retail always follows. Call your local dealer right now. Ask them what they have in stock physically in the vault. Most will tell you the same story. Limited availability, long shipping times, and premiums subject to change. That's the real market tonight. London either catches up or becomes irrelevant. Here's a key point. The flows are screaming that tonight matters. We're watching data, not headlines. And right now, that the data shows a market under extreme stress. If you're getting value from this breakdown, hit that subscribe button and drop a comment below. Let me know you're paying attention because this analysis is for people who want to know what's really happening in precious metals. Now, there are likely two types of people watching this. About 65% of you are long-term stackers. You're buying physical metal. You don't care about hourly charts. What you care about is decadal-long wealth preservation. You're watching for confirmation that your thesis is still intact. The other 35% are active traders. You're deep in futures, options, and mining stocks. You want specific levels, specific times, and specific triggers. This breakdown is for both of you. We'll start with the big picture and the macro context and then drill down into the exact levels and times that matter for the upcoming London Open. So stay locked in. Let's get into the mechanics of tonight's London session. The LBMA silver fix happens twice a day. There's the morning fix at noon London time, which is 7 a.m. Eastern. But the real action, the real price discovery happens in the pre-market session. That kicks off around 8 a.m. London time or 3 a.m. Eastern. That's when the major banks start positioning themselves before the official fix. So here's what to watch for at 3 a.m. Eastern. First, level 1, the $88 resistance. Silver has tested $88 3 times in the last 72 hours and been rejected every single time. The 50-period moving average on the 4-hour chart is sitting right at 87.83. Above that, you've got the 2,000 period on the hourly chart at 89.40. If London opens and we break above $88 with serious volume, the next target is the $92 to $94 range by the morning fix. That $89.40 level is the first hurdle, and $92 is the swing high from last Tuesday. Next, level 2, the $84 support. Looking below the current price, $84.20 was the low from yesterday's Asian session. If we go lower, $81.50 is the weekly pivot support. If London opens weak and we break below $84.20, we could absolutely retest that $81.50 mark. But here's the thing to remember. Any dip below $84 should be met with massive physical buying coming out of Shanghai. Why? Because the arbitrage at that level explodes to over 25%, and that's just not sustainable. This brings me to level 3, and this is the most important indicator tonight, the Shanghai premium spread. Right now, it's sitting at 21.3%. If this spread starts to compress down towards 15% because London's price is rising, that's incredibly bullish. It's a convergence. It means the West is finally catching up to the East. But if this spread expands towards 25% because London falls while Shanghai holds steady, that is a major warning sign of imminent dislocation. It means the paper and physical markets are completely divorcing each. You need to watch the spread, not just the price. Let's quickly touch on technical indicators. The RSI on the 4-hour chart is at 58. It's not overbought. It's not oversold. There's plenty of room to run in either direction. The MACD histogram just flipped positive for the first time since the last big drop. It's an early signal, not full confirmation, but it's notable. The volume profile shows a huge amount of trading happened in the $82 to $86 range over the past week. We've clearly built a solid base of support there. The big question is whether we break out of it tonight. Finally, the 150-period moving average on the hourly chart is at $91.20. We crashed below it and haven't managed to get back above it yet. Let me be very clear. The data right now supports both a bullish and a bearish scenario tonight. So let's break both down. First, the bearish case. 1, bond yields are still climbing. The 10-year Treasury just hit 4.87%, its highest since last October. Rising yields typically pressure precious metals because they increase the opportunity cost of holding a non-yielding asset like silver. 2. The dollar index is holding firm. The DXY is sitting at 104.2, refusing to break down. A strong dollar is a headwind for commodities. 3. Liquidity stress is a real threat. When markets panic, people sell everything first and ask questions later. We saw this in the COVID crash and in 2008. Gold and silver aren't immune to forced selling. The VIX is at 29, which signals elevated fear. When fear spikes, margin calls forced selling across the board. 4. The London banks might defend their massive short positions. We're talking 284 million ounces of short exposure. That gives them huge incentive to push the price down. Never underestimate powerful players when their interests align. And 5. The $88 resistance level is real. We've seen 3 rejections in just 72 hours until we break and hold above it. The bears control the short-term chart. If we fail at $88 tonight, we could see a retest of $81, $50. If that breaks, the lower levels come back into play. That's the bearish roadmap. But now, let's talk about the bullish case, which many believe is much stronger. 1. Physical scarcity isn't just a story, it's a fact. 12.7 million ounces left London vaults last week alone. COMEX registered inventory is at multi-year lows. Dealers worldwide are reporting trouble sourcing metal. This isn't speculation. This is reported data from the LBMA and CME. 2. The Shanghai premium is screaming. A 21.3% premium is not normal. The historical average is 2 to 3%. We are at 10 times the normal spread. This creates billions of dollars of arbitrage pressure. Eventually, that pressure has to resolve. Either Shanghai comes down, which requires physical metal to be sold into China, and that's not happening, or London goes up. Arbitrage math is undefeated over time. 3. Central bank buying hasn't slowed down. We've seen 33 consecutive months of net purchases over 1,000 tons in 2024 alone. When central banks buy, they aren't trading. They're accumulating for the long haul. The biggest, most sophisticated money in the world is a relentless buyer. 4. The COMEX short position is incredibly vulnerable. There are 142 million ounces of open interest against only 31.22 million ounces of registered inventory. That's a coverage ratio of 4.5 to 1. If just 25% of those longs decide to stand for delivery, the registered category gets wiped out. That's a technical default. The slightest hint of that possibility will send shorts scrambling to cover, driving the price up. 5. Seasonality is on silver's side. Historically, March and April are the strongest months. You have Indian wedding season driving physical demand. Industrial restocking after Chinese New Year and Western investment demand picking up after tax season. 6. New mining supply isn't coming online. Global silver production actually declined 1.3% last year. Miners have been cutting capital expenditures because prices until recently didn't justify expansion. The supply response to higher prices takes 5 to 7 years to materialize, but the demand is here right now. 7. The gold-silver ratio is still screaming that silver is undervalued. It's currently at 56 to 1. The historical average is 47 to 1. The high in 1919 was 17 to 1. If gold just holds at $3,000 and the ratio returns to its average, that gives us $16 silver. If it overshoots to 30 to 1 like it did in 2011, we're looking at $166 silver. And finally, 8, the macro backdrop is perfect for hard assets. U.S. debt is at $36.44 trillion. With the deficit running at $2 trillion annually, the Fed is trapped between fighting inflation and causing a recession. We have escalating geopolitical tensions on 3 continents, and dollarization is accelerating among BRICS nations. This is the exact environment that historically drives capital into precious metals. So where does this leave us for tonight? Let's break it down into actionable points. First, keep a close eye on the 3:00 a.m. Eastern pre-market. This is when the real positioning happens. If we see a decisive break above $88, the morning fix will likely be higher. But if we get rejected there again, expect a pullback toward the $84 mark. Second, watch the Shanghai premium. It's currently sitting at 21.3%. If that number compresses and drops below 18%, it means London is catching up, which is a bullish sign. However, if it expands past 24%, it signals the dislocation between paper and physical markets is getting worse, bringing more volatility. Third, monitor the comics inventory updates. They post these daily. If we see another significant withdrawal from the vaults, it confirms that physical supply stress is accelerating. Fourth, the key level to watch is $91.20. That's the 150 period moving average on the hourly chart. If we can reclaim that level and hold it, the correction is likely over. But rejection there means more choppy price action is on the way. And fifth, remember, this is a process, not a single event. Tonight is important, but it's just one piece of a multi-year puzzle. Don't overtrade based on one session. Let the data be your guide. Now let me speak directly to both groups watching this. If you're a long-term stacker, tonight is just noise. You're not looking at hourly charts to plan your retirement. You're accumulating physical metal at prices that will look cheap years from now. If you can get your hands on metal with reasonable premiums right now, you're ahead of the vast majority who won't notice until prices are significantly higher. Your job is simple. Buy what you can afford, store it safely, and ignore the short-term fluctuations. If you're a trader, tonight is an opportunity, but it's also filled with risk. Use defined risk positions. Set your stops before that 3 a.m. candle, not during it. Know your levels. $88 is resistance, $84 is support, and $91.20 is your trend confirmation. Don't chase the price. Let the move come to you. And for everyone watching, this is important. Never trade with money you can't afford to lose. Never use leverage that could wipe you out on a 10% move. And never assume any prediction is a guarantee. Markets are unpredictable, and this analysis is educational, not financial advice. Tonight's London Open is crucial, not because it will definitively tell us if silver is going to the moon or crashing, but because it will reveal whether the paper market can keep ignoring the physical reality. Premiums at 21%, millions of ounces leaving the vaults. Dealers struggling to source wholesale bars at spot. Something has to give. The bet here is on physical reality. The bet is on 5,000 years of monetary history. The bet is on math. The paper price can lie, the vaults cannot. Let me give you 3 final takeaways to lock in. 1, the Shanghai premium at 21.3% is 10 times normal and creates billions in arbitrage pressure that will eventually force price convergence. 2, COMX has 142 million ounces of open interest against just 31.2 million ounces of registered inventory, a ratio that's unsustainable if delivery demands increase. And 3, tonight's 3 a.m. Eastern pre-market will show whether London acknowledges the physical shortage or continues to price as if paper and metal are the same thing. Stay sharp, stay positioned, and stay patient. If you found this breakdown valuable, hit subscribe and drop your thoughts in the comments. Let's navigate this